What's up everyone, and welcome to our video on market makers. If you haven't already watched our video on hedge funds and hedge fund strategies, do make sure to watch that video as it'll tie in nicely with this one. So just jumping straight into it, in this video what you're going to learn is where you'll find market makers, who those market makers may be, how the market makers make money, and the advantages and disadvantages of using market makers. And knowing this will really help you understand any conflicts within the industry and actually how the industry infrastructure is made up. So where would you find market makers? Market makers themselves, they're actually in most markets. So they can range from stocks, bonds, and currencies, and you'll find them in all three. So in stocks, it's a little different as they're traded through exchanges worldwide, like the New York Stock Exchange and London Stock Exchange. But currencies, on the other hand, they take place over the counter. So over the counter meaning there's agreeable buyers or sellers in the world. So it's not centralized in an exchange. And this exchange rate can actually vary from broker to another. So if I was using, let's say, one broker that's in the UK, but it's not accessible in the US, the US broker may actually offer different prices. Now, who would the market maker be? In general, there's two big market makers, and this is the big banks and the brokers. Now, the big banks, these are the main guys. These are the main market players because they account for most of the trading activity. You know, they have access to what's called the interbank market, which is not accessible for retail traders. So how do retail traders access the Forex market? Well, this brings us on to the other market maker, which is the brokers. Now, with brokers, there's generally two types, which is the ECN, which is the electronic communications networks, or there's the market makers themselves. And in this video, we're primarily interested in what we call the market makers and what they're doing, how they make money, as it's really important for us retail traders to know the infrastructure. So what are they doing? How are these market makers making money? So how they make money is they offer quotes, something called in the Forex market, like currency quotes. And they are actually obliged to offer these quotes throughout the trading day so that people can buy or sell and trade assets. Now, these quotes themselves, they come in two halves, sometimes known or thoroughly known as the bid and offer price. And how they make money is the difference between this bid and offer price. So Forex traders that are already trading out there may actually know something called a spread. And this is how the market makers make money. So what they'll do is they'll offer you a bid price, for example, of £100, an offer price of £120, and the difference of this price is 20. And this is what they'll make if you are buying or selling the asset. Now, in general, market makers will actually try to rip you off. So they'll buy as cheaply as possible from you and then sell you at a really high price. But depending on how competitive the market is, these prices can actually become narrower, which makes spreads cheaper. So in the Forex market, you'll tend to see that most brokers now offer really tight spreads because there's so many Forex brokers out there that they really can't compete on anything else except for spreads, as they're all offering similar charting tools, they're all offering similar trading platforms, and in general, because it's so homogenous that they can't compete on anything else except for these prices. So in general, Forex trading costs are actually coming down. So what are the pros and what are the cons? Well, the main advantages of using market makers is that the market maker themselves will offer you that free trading platform. So in this free trading platform, you can then access things like charting software, the tools for charting software, and even news feeds, so you can keep up the track with the news as well. And this makes accessing the market itself way more affordable. So in general, these trading platforms can actually be more user-friendly compared to institutional platforms. You'll see on movies like Bloomberg, they have this thing called Bloomberg Terminal, and it looks really rigid, not very user-friendly at all. You know, the color scheme is not there, and it's really just not up to date with modern day user-friendliness. So nowadays, most of these market making broker platforms are actually really easy to use. But just because you have easier access to the markets, it doesn't actually make you more profitable. In the end, it's the analysis approach that makes or breaks a trader. Just because someone in Africa has access to a trading platform on their mobile phone, it doesn't actually make them any more profitable. If anything, just because they have access, it actually makes them more likely to lose money because they don't know the proper methods of, analyzing the markets and approaching the markets and even how the market's set up. And that's why we're covering this video on market makers, so you understand the infrastructure. So what about the disadvantages? Well, there's a lot of disadvantages. So the main one is that they have an inherent conflict of interest. Market makers and retail traders, they don't really go hand in hand because market makers are actually trading against the oppositions. So they're actually incentivized for you to lose. And you probably see this around this conflict of interest with brokers, that brokers are actually incentivized for you to trade as frequently as possible and with as much leverage as possible, because this way they make more money through spreads and commissions. And as we've already said before, they want the best prices to buy or sell at. So they may actually display to you worse off currency quotes. So this can be 10 to 15 pips from the actual market rate, which is a crazy amount for some scalpers and day traders out there. But even though we don't agree with that method, it's a big cost. They can actually do this, and it can actually mean the difference of your stop losses being hit, your take profits being taken, or even your orders being triggered. And this is probably why you'll see a lot of people complaining online about orders not being triggered or being taken out by a stop, and then the price moves in their favor. Because this can actually happen, especially if the market maker and the broker that you're using is unregulated. Another disadvantage, obviously, is that the higher volatility actually creates much wider spreads. And why is that? The market maker wants to profit just as much as you do when there's these high volatility times. Why else would they want you to trade on news itself? They increase the spreads significantly, 2, 3, even 10 times. So they're making 10 times spread while you're just making little pennies. So it makes no sense to why you should actually trade on news itself, because the costs incurred of trading on news due to the increase in spread actually outweighs the gain. And there's actually something called slippage that can happen during these times. So in high volatility times, slippage can occur, which means the price might actually exceed your stop or take profit. And this can actually incur way more risk than you actually thought, which is really dangerous. And you really need to keep an eye out for these slippage times, because this slippage can actually occur even in liquid markets such as gold, but on exotic markets such as USD TRY, this slippage can really hit you hard. And that is it basically for our video on market makers. We'll just do a quick summary of what you should know after this. And basically, market makers, they're a vital part of the structure, but without them, it would be really costly for us to access the market. So they're a really key role in the markets themselves. You're likely not to deal with the market makers directly, but you'll access them through a broker. And in Forex, there's loads of brokers. So in general, it's really competitive, and you'll see much lower spreads nowadays. You just really need to watch out for the regulated brokers, because you don't really want currency manipulation going on. Another one is that market makers, they keep the market running. So they have that obligation to offer you the quotes to trade all day, all throughout the trading day, and they're trading as well. And just some points to watch out for is that spreads will really increase during illiquid assets and really high volatility times. So in Forex, this is the exotic currencies, you'll have much wider spreads, and in times of high impact news as well. So in this high volatility, spreads will become very wide. This makes the trade itself more costly. Brokers make more money, the market makers make more money, but you actually make less. And that is it. That is it for our video on market makers. Thank you for watching. Do make sure to subscribe, And if you're actually interested in learning some Forex fundamentals, how to analyze the Forex markets, you can actually sign up to our academy. You can just sign up the interest for free. And yeah, that's it. Thanks for watching, guys.